If I was coaching somebody, I would tell them, don't ever underestimate the ability of brokers to put deals in your court if they like you and you're easy to work with and you build that rapport. Like it's in our niche, it's everything.
Welcome back. This is episode 73 of Keeping It Real Estate. Today, we are joined by Blake Comfort, managing partner of Comfort Communities. Comfort Communities is an investment firm and management company that specializes in buying manufactured home communities, primarily in Arizona. Blake has been in the real estate investment industry since he was 18 years old and has over 15 years of experience. This episode is going to be extremely valuable, you guys, especially to those of you who are just getting started in real estate investing. So Blake, welcome to the show.
Thank you. Great to be here.
Yeah, great to have you. Do you want to maybe give a little background? I mean, it's pretty unique that you've got 15 years of experience. And how old are you?
I'm 33. So we bought our first mobile home park when I was like 18, 19.
So let's give a little, background there. How are you buying mobile home parks when you're 18, 19 years old?
So I started diving into real estate investment when I was just kind of still in high school, but mentally kind of exiting senior year. I didn't want to go to college. My mom wanted me to go to college. My dad was impartial as long as I got my butt in gear and did something. And my dad was also looking to switch gears from being a general contractor and building multifamily. He started building houses and stuff and then ended up in multifamily, had a great career. But, as most people know, they're probably trying to get into real estate investment. There's not really any end to that unless you do a great job of managing, saving money and managing that. So he never ended up with any ownership in deals. So we started studying when I was like 17, going to Rich Dad, Poor Dad seminars at the time. And really we're after how to get into like 20 unit apartment deals or maybe 10 units or, even looked at fourplexes and triplexes and like all that standard multi kind of side. The fix and flip was kind of always never that shiny to us because we liked the idea of having several units to where if one unit was down, it was a percentage of your total income versus the whole house, going vacant for a couple months. So we dove in heavy. I got my real estate license right when I was 18. Kind of started selling condos and houses just as like a buyer's agent, but I sold a few just to survive. Luckily, I was young, so I didn't have to pay rent at that moment. I was still living at home. So my dad had a home office, so on my commute, my mom hated it. She's like, "You got to get the hell out of the house." So I'd commute to the office and be looking into stuff, selling real estate out of like Prudential in La Mesa in California. And sold a few and realized that I just didn't like focusing on residential as I was learning about multi. And we were at a seminar, Rich Dad pointed out the mobile home park, maybe manufactured home community space and about homes you could flip and rent and or sell notes and that whole thing. But then also the better thing was to own the community in the end. And when Dad and I heard about the community aspect, real estate ownership, pretty substantial amount of land that you're owning in a mobile home park, that is great land, covered land play that you're buying on a cap rate, just like apartments, but you're getting more land. So it's like, all right, well, there's a huge hedge on just if something happens with the mobile home park, you have a significant amount of multifamily land. For the most part, a lot of the zoning remains multi. So you can build apartments on it. And Dad was comfortable with that. So the whole piece, we just light bulb moment. Let's focus on trailer parks, mobile home parks, manufactured home communities, kind of all the same thing, just different quality. And the first deal, we chased deals all over the country, tied up deals on credit cards. We really didn't have any money. So our earnest money was literally swiped on, I forget how we did it, but we somehow were able to get money into the bank and then transfer it and tie up earnest money with credit cards. And wow. They were smaller deals. They were under $1 million total purchase price. Maybe 30. We really wanted to get to 25 plus units And so you could go back east and get them a lot cheaper, but we found out why. We tied up a couple, and there's a lot to those. There's a lot of like sewer treatment plants and wells and things that are really difficult to understand and operate effectively and efficiently from a cost standpoint. So we kind of got spooked of those, and we're like, all right, Colorado Rockies West. Let's focus in real estate that we kind of understand, at least geographically. And we understand septic systems, but we didn't understand sewer treatment plants and the complexities with those. So we type a few deals, and then we finally land our first deal in Brighton, Colorado, which is just north of Denver.
Oh,
good market. We were after markets that were meaningful in the end. Like we wanted to be within the metropolitan areas, because so that you always have a fallback of like, all right, you need affordable housing within this metropolitan area. Like several million people. We kind of made it a thing to be at least a million people, kind of initially. And so we buy this 28 unit mobile home park in 2008 to 9. We bought it 600 grand. So 28 units for 600 grand, is very doable even for us at the time. We didn't have a lot of cash at all at the moment. And so we raised like 250 grand, 200 grand down, like $50,000 CapEx kind of budget. Looking back, I'm like, that's ridiculous. Like that's hardly any money for CapEx, but we, regraded the roads, built a park, just renovated the like a swing set, made it like a cool little community center, renovated the laundry room and operated it. We bought it at a 12 cap.
Wow. Yeah.
So
have that property?
We've now sold it. We operated it for 10 years.
What did you guys sell it for?
1.4.
Okay. So you bought it for 6, you sold it for 1.4 10 years later.
Yep.
Good for you guys. And so I got to ask you a question real quick. How did your dad get you, or how did you become so interested in real estate and just being eager to learn about money at a young age? I mean, that's kind of unique a little bit. I've been to conferences for the last decade, and I rarely see kids under 25, and pretty rarely under 30.
I've thought about this. I'm not exactly sure. My dad and I were really close. We did a ton of fun stuff together, and we did family ski trips. And him and I rode motorcycles together. We did some pretty cool, like father-son dynamic things. And so, like we rode Harleys when I was 18 to New York, and then the next year we rode to Vancouver, Washington, or just across the border to Vancouver, Canada. Like we did things that most father-son don't. And so I think it was just. I saw what he was up to. There was a moment in time where when he closed his construction company, it was like I could either run and go do my own thing as a 19, 20-year-old kid, but I really just enjoyed it from a young age. And, my family didn't at that moment. It was 2006 and 8 was a bad kind of time period for construction. So he was kind of in a pickle. And so I think what I've learned about over the hindsight now was that I really was interested in helping my dad get out of his pickle, because it was kind of like, what do I do? Like I can peace out and be a kid and go do kind of screw off, or go to school or whatever, but that wasn't what I wanted to do. So he needed to figure out a way through. He was interested in this. We were collectively, him and I together, were really interested in it. So it was kind of like another adventure. In that moment, it just felt like, well, hey, let's figure this out together. We were very different. So my dad's gone now, but we were very different, and it's interesting to look back on our whole adventure and progression. He didn't like making phone calls and raising money. He was a numbers guy, more or less like an analyst, and he did all the construction contracts and the bidding on bigger multifamily projects like 200, 300, 500 unit deals. So he was very detailed. So that was really good for figuring out the underwriting, but he really didn't care to do any of the broker functions like in acquisitions. So like I just searched and searched and searched, and then we'd kind of underwrite the good ones, and it lit a fire, and him and I had a heck of a time and a good time figuring it out. So wow. I think it's just, we had a great relationship. He needed me in a way. I really wanted to learn.
Yeah. That's awesome, dude. I love that story, So you're saying your dad, he passed away, as you're saying?
Last year we lost him. He had a massive heart attack.
Oh, I'm sorry. So sorry to hear that. hard to hear. But you know what I love about that story is I've got kids, and I think about how do I motivate my kid to be, or whatever he wants to do. I'm not saying he's got to be a real estate investor and come down this path, or my kids, but how do you connect with them to inspire them? And I mean, clearly the relationship you had with your dad moved you enough to say, hey, I want to help and I want to be a solution to a problem here. And that's really admirable. So awesome.
I'll just add a fun little spin to that story. So the magic moment in time for me to become a man was we bought one deal. So we were kind of in it together. We're in escrow on the second deal, and my dad goes completely blind.
Oh,
Completely blind. Like, you know, and he was more or less a pretty cool, badass guy. You know, like he hunted all over the world. He rode motorcycles with me, and like that was more or less my thing, but he did it anyways, but like successfully. Then he goes completely blind on our second trailer park deal. And that was like the moment where I knew it was like, all right, I'm going to stick it out. I'm going to figure it out. He actually had landed a developer job because we didn't have enough money at that point, 2 trailer parks, mobile home parks to survive. He was building and developing a 278 unit in Chula Vista for one of the operators here. He had kind of bumped into a broker that he knew and pitched it from a development standpoint. So then he got that developer contract, goes blind after like 2 or 3 months later. And so then it really solidified, you know, him and I running around, you know, doing deals and working together and playing to our strengths. And it was what made me a man. You know, there's that moment in time where it's like, all right, I got to step up.
Yeah.
And luckily, in hindsight, that was one of the best things that ever happened to me. I was 19, 20 years old. It was my 20th birthday that he went blind.
My gosh. Wow. Unbelievable. So let's curveball a little bit more into how you guys are buying these deals and when you're spotting an opportunity. You know, for a lot of our listeners, this is a multifamily real estate podcast, but we just wanted to bring another idea or another asset class to our listeners. What is it that when you're looking for this stuff, you're like, yeah, that's a good deal, and here's why we think it's a good deal? What are some of those key metrics you guys are tuning into?
So I really like more units if you can, you know, over 30 units. Even if you're starting out, you know, it's like get to 25 to 30. That's kind of how I look at it. You can go out of California and buy a lot more per space or per unit, you know, per dollar. So you can buy 30 units for a lot less than if you were to buy 30 units in San Diego or LA or whatever. And so we did that initially, and that's kind of what landed us in Arizona. And so a good deal for me is, you know, now it's 100 units or more for mobile home parks. I'd buy 60, 80 units if they're down the street, like, you know, really easy and they're decent quality. We'll still bolt on like those 60, 80 unit deals. But I like the scale. Everything gets easier with scale.
Yep. And what kind of, you know, returns are you looking for over a 5-year period? I'm assuming you're raising capital from investors. What are you projecting for these investors as far as overall returns and cash flow?
So our cash on cash, just cash flow from an investor standpoint ongoing, has been starting around a 5. Mostly I make sure it kind of hits a 5. Like I'll figure out a way to hit a 5. From a money raising standpoint, anytime I ever pitched below a 5, I've always got a extreme amount of pushback. So I always aim to get a deal that can pay or pretty damn close, you know, a 5% year one. And then I start increasing rents or executing on whatever the value add is, whatever meat's left on it. And then our deals have kind of averaged around a 6.5, 7 throughout like a 5 to 10 year hold. The 10-year holds typically are a longer deal. Like we're putting on 10-year debt. They're more stabilized to begin with, and so I just sell it as more of a cash flow play with appreciation in the rents. We have I would urge, you know, a lot of multifamily people, especially people starting out, to significantly dive into mobile home parks. I think they're already starting to become, you know, a huge industry in itself, even with huge multifamily operators. We're selling a mobile home park to a $50 billion multi firm right now. So like there's a huge attention on the space to where if you get, you know, 20, 30, 50 unit mobile home parks, they're tremendous multifamily assets. They're just a little different. But go ahead.
Yeah. So when you're saying, it sounds like a 6.5 to 7% cash on cash, and what's your overall, projection? Just your number you project over a 5 years. Is it a 5-year hold or 10-year hold, or how long are the holds?
We typically do 10-year holds.
10-year holds. Okay. Gotcha. And what do you project over that 10 years about?
So I try to hit a 20% return. I'd probably be like a high teen IRR.
So annually, that is?
Yeah.
Okay. Okay. So you're saying like a 200% return over a 10-year period is kind of what you might think you might see.
Yes. Yes.
Okay. Gotcha. Good stuff. So when you're putting debt on these deals, what kind of debt is it? Is it Fannie? Is it bank loan? Or how do you get debt for these investments?
So Fannie Freddie now is our main source of debt. There's several brokers that kind of do that. And then on the rougher ones that are kind of heavier lift or a little bit smaller, below a $2 million loan. So people starting out, you're going to be just hunting for bank loans, either locally or there's a couple of particular banks that really love the space. And they're pretty straightforward, 300 or 300 basis points or 3 points over whatever the 5 or 7 year treasury, whatever the length of time you're after. So it's pretty reasonable. 30-year amortization with the banks, with Freddie and Fannie. It's been a lot of Freddie Mac as of lately. For some reason, they're just more competitive right now over the last couple of years. So Freddie Mac's been giving us 5 years of interest only on a 10-year term.
Gotcha.
So yeah, just very similar to multi.
Yeah. And what kind of leverage are they giving you? 60, 65, 70, higher or lower?
Historically, 65, 70. Right now, we're kind of landing between 50 to 60-ish. More trending lower just because of cap rates in our space have really not corrected. There's just so many buyers. So cap rates are still holding, roughly 5%.
Wow. And how many deals are you guys looking at? Let's just say on an average month, how many deals are you seeing come across your desk? Is everyone around the country looking at them? It sounds like you're saying Colorado West is your playing field. I mean, how many deals are you guys seeing?
I probably look at, realistically, seriously consider like 3 deals to 5 deals a week. And a lot of them are small now. So like a lot of them, I'll get a 50 unit sent to me, and I want to wait for, I'm being a little bit more choosy now on 100 unit plus, or maybe even up to like 300-400 units, or a couple of communities that sell from the same owner. And so those are the ones I'm kind of waiting around for, if I'm honest, because I hear about them come in. I hear, what's going on because I'm now so plugged in our particular niche. But so yeah, we're, like I was telling Josh, we are currently, we've sold 2. We're in escrow to sell another 4. And so we'll be rolling that money, roughly 30 million in equity, that we'll be buying either several bigger deals that are, tenant in common ownership, or we'll be doing a few more smaller deals throughout the year. But then I have a pipeline of investors that love to invest. And so I'm trying to probably buy like 6 or 8 deals this year.
Good stuff. Cool. And then where are you getting these deals? Are they from brokers, or how do you see them?
So mostly, probably 80 or 90% of our deals are brokered deals with a listing, or at least with the, the permission to market them and spread them around their email list. But most of it is off market. Gotcha. And I think, so if I was coaching somebody, I would tell them, don't ever underestimate the ability of brokers to put deals in your court if they like you and you're easy to work with and you build that rapport. Like, it's in our niche, it's everything. Like
same in multifamily, really. Are these brokerage firms that are selling, are they like the big dog, like CBRE and Marcus and Millichap and stuff like that, or is it smaller local firms?
Depending on the geographical area, an Arizona guy, a friend of mine, he's kind of ended up with the right personality, the right place at the right time, because some of the older guys retired. And the big firms would love it, but they just don't focus like he does on Arizona. So he's ended up kind of in the right spot. And then, but CBRE, Marcus, I mean, they do, like the Marcus and Millichap guys are the 800-pound gorillas. They do like $2 billion in sales a year in just manufactured housing. Okay. So like they're substantial, but so yeah, it's all the big name brands have manufactured housing arms to them.
Awesome. And then when you say kind of CapEx, it's like you come in and fix these properties up. What kind of value add are you putting into these places? And what's your kind of a timeline on something like that?
So 2 to 3 years to do. So like I'll use a heavy lift value add that we bought last year. It's called Romero Mobile Home Park in Tucson. If anyone wants to look it up, it's 112 sites, and it's got 35 vacant sites, and it came with 30 vacant homes that need to be renovated.
Okay.
And so, significantly vacant, over half is we're dealing with one way or another. And then we and a cool thing with ending up in Arizona and kind of focusing in was that we decided to become a dealer and really, really grow roots operationally there. And so we became a manufactured home dealer, so we can floor all the inventory and buy direct, just like a car dealer, flooring cars on their lot. We floor home inventory and buy direct from the manufacturers and floor it in our communities for sale.
Okay, wow.
So it's a nuance, but yeah, we fill them and keep them full that way.
Okay. And so what kind of CapEx are you doing as far as, you're completely renovating those vacant homes, or when you say you have 35 or 30 vacant homes and 35 sites that are vacant, what does that mean?
So I put 35 new homes, depending on the size of the site, on those 35 sites, and I have to improve the infrastructure, electrical, sewer, water, to them kind of the layouts there, but typically we are putting a little bit bigger, wider home than was originally designed. So then we completely renovate that infrastructure piece to put the right home sizes in for those 35. We might lose a couple just because we are wanting to make it nicer. And then on the homes, we renovate with teams, and we have a team now that we employ on payroll, and then we also hire vendors if we have a bunch of them. And we do safe flips. Like we're not going crazy. We're spending like 10 or 15 grand on a mobile home. That's like a 80s vintage single wide. Maybe it's a 2-bedroom, 1-bath, 600 feet or so.
Okay.
So they're small 2-1s, but yeah.
And you said 1980s built. Is that where these are about, most of them?
Yeah, the parks that we're buying are typically, 70s, 80s, 90s vintage homes.
Okay. And any reason for that you're going with that versus newer?
The newer properties, that would be the equivalent of like me asking you why you don't buy Class A every
Gotcha.
deal. It's like, well, I need some juice to squeeze out of it. Yeah.
Yep. Need some value add.
Yeah. So we're a value add shop.
Gotcha. Okay. Good stuff. What else would, for listeners that are maybe interested in this asset class, what else should they be asking, or would you think they should be, needing to know about this asset class?
So this asset class is a hidden gem in all of multi. Turnover on a stabilized mobile home park is 3 to 5%. So you really, once you get it stabilized, when you go into a poorly managed deal, there's a lot of work, and it's not passive. At that point, like you bought a business and you got to fix it. It's something's wrong with it. Just like buying a old apartment deal that needs a lot of work. And so you go in, you fix it up. The turnover, it ends up becoming, if you go in and make it nicer and add value and do the clubhouse and the pool if it has it, and whatever, the signage, whatever it has to be celebrated, you do it right. You elevate the community feel. Every home you touch, you paint and skirt and make it nice. What happens is the home values actually go up, and they own the homes. And so there's a very different piece there. So rather than us owning the homes and being like a single family rental community, we don't own the homes. We lease them the space. The space rent's like roughly $500, $600 a month in Arizona, and they own their home. So there's a pride of ownership. And then therefore they can't just leave. They own that home. They might as well sell it for 10 or 20 grand or more, depending on the community. So
these residents, they own these homes. You don't own the actual individual sites. They buy them from you.
Or they already owned them when we bought the community.
Okay. Yep.
We're kind of like the owner of the HOA. Like that's kind of how it functions. Yeah.
Gotcha. Okay. Gotcha. So, okay, that's good. I thought you owned all of the homes and were leasing it back to these residents as rent, but that is not how it is.
We do that only if needed.
Okay.
You know, we'll do it on newer homes if we blast a bunch of new homes in there and floor a ton of inventory. It's a lot easier to rent a bunch of homes on like a fill up than it is to sell. So then we'll do it and then we'll taper off our rentals upon turnover. So then we'll like, you know, let's say 3 or 4 of them a year out of 30. That'd be 10%. So that'd be a heavier turnover for this space. But let's say it is, we'd sell those off rather than having 35 for sale all at the same time.
Understood. Gosh, that's great. How many people are on your team right now, Blake, that help you run the company?
So we've now, in the last year, we've grown over 50. That includes a larger apartment deal that we still manage. So on the mobile home park front, it's like 40.
Gotcha. So when you say 40 employees that work for your company, is that what you're saying?
Yep. And that's management. So we self-manage everything. So that's a lot of it is the management, probably 30 of the 40, and then 10 in our corporate office.
Okay, gotcha. And so when you have management, and like, give us an example. Where are some of your sites? Are they all over the West Coast or the West, or where are they, most of them?
So we have 22 communities in Arizona, Phoenix and Tucson.
Okay, that's your main focus in Arizona.
It's our main. Every time I'm gonna make a move to go to Texas or Florida, and I'm looking at deals seriously, another Arizona deal will pop up. And then now we've become a consolidator. So like Blackstone, Carlisle, they'd all love to buy our entire company. They don't really necessarily want one deal from us. They want the whole thing. And so it's really valuable if we just keep buying Arizona deals.
Gotcha. Do you guys see yourself ever going to Texas, or are you just going to stick around Arizona?
Oh, yeah.
Okay, eventually Texas.
Yeah, we'll be nationwide eventually. And Texas is just a huge market for us. It's the number one state for quantity of deals for mobile home parks. And then Florida's also heavy up there. And then we like some other states along the way, you know.
Yeah, and then when you guys started, you know, you got the light bulb flash. You're like, "Whoa, mobile home parks is the way to go." How did you learn how to manage these deals? Just trial and error, or was there some sort of training you went through, or how'd you figure it out?
We did. Okay, so we bought a course through Rich Dad Education back then. So, and it was like my mom thought we were so ridiculous. We spent $26,000, which in hindsight is a lot of money that we didn't have. We borrowed it from my grandma, and then watched everything. We were invested at that point. Like we watched the whole thing, and then it was like a early version of a online like webinar.
Yeah.
And so it was like 2 days a week, and then you could be watching pre-recorded stuff. And so we did that for, I don't know, maybe 2 or 3 months. And then you just did it, you know, like in the end we did it. And then like, I still to this day look back on some of my old underwriting and I laugh like, what the hell was I thinking? Like my expense ratios, I was taking the broker's words for it on certain pieces that I just didn't know. And we wiggled through it, you know?
Yeah. Yeah. Have you guys ever lost any money in the business so far?
We haven't lost money on deals from a valuation standpoint. We had to sue a city on the first deal in order to sell it because they were telling us they were going to condemn us. We had too many violations, but it wasn't our violations. It was the residents that built extensions on their trailers. And so like, we're like, hey, we can go in there and tell them to rip it out. But like, at the end of the day, like this is a big issue. They've been there, like they've had these trailers there and the additions there since like 1955. You know, so we had to like argue it, and that was the closest we got to really having a major issue. But they backed off and with a historic precedence, and we were able to sell it. And I always thought it, you know, we sold it a little bit low given what it was after we were done with it. But hey, you know, we moved on and it was all good.
Yeah. How many deals have you guys had that have gone full cycle?
7.
7 deals full cycle.
Yeah, maybe a little bit more now. I'd have to make sure I recounted, but yeah, at least 7.
And what's kind of average returns on those deals? You have any idea?
Most quick math is most 100K paid out between 2 and 250.
Okay.
Upon exit, and then we did 1031s with the partnership into bigger deals.
Gotcha. And are these investors just friends and family, or how did you guys source your equity in the beginning?
All friends and family. Wow. You know, accredited for the most part. like we're in San Diego in like La Mesa area. And so most people are accredited if they have enough money to put 100 or 200 grand in a deal. And so we just kind of kept going and calling. And yeah, in hindsight, like I'm really happy we did that. We did it out of ignorance. We didn't know about other means to raise capital. And there really wasn't as much information accessible at that point, like when we were learning. So we did it really simple, just accredited investors, keep it, friends and family. And obviously we started small because of that, raising a couple $100 grand at the beginning, to then we went to raising 600 grand, then $1 million,
Yep. Let's say, what are the biggest things to be thinking of that can go wrong? What's some of your biggest challenges you've had? You're like, dang, I didn't expect this. And this is something that's, there's, every asset class, there's some of that, what would be some of those things for mobile home parks?
Something that we're getting a lot better at is assessing the total systems of electrical and plumbing. Because we have a huge, like now, like we converted a deal. I'll give you an example. The only thing that I sort of missed on heavy, didn't lose money, but definitely missed on underwriting, was we converted 37 failing septic systems on 25 acres, 200 unit trailer community or mobile home park, to city sewer. And we thought we could get it done off of a bid that we got. We got several. We went with we looked at them. They all looked to be apples to apples. We went with the lower guy, but he had good recommendations from several other big operators. Anyways, it was 800 grand, the quote. So I budgeted for like 9, and it was $1.5 million. And then some other issues, came from pulling the string and residents upset. And we had guys calling us, every government agency along the way, because we had a huge construction project going on for this community and they were inconvenienced. And so they'd get pissed and call every, you name it, government entity, and they'd be shutting us down for anything, dust control, you name it. So then that added cost. So it ended up being like $2 million on a $900,000 budget.
Oh, wow. That's serious. Gotcha. What are your guys' future goals looking for? Let's say the next 5 years, Blake, what are you guys looking to do?
So we're roughly this year, we'll round out close to 2,500 units. And I just brought another guy to help raise more capital, more professionally, but we're still going to hold more or less like a friends and family type capital raise structure. I've learned a lot over the years from different guys about going into, the institutional capital and any of that private equity space. And so we're not going to do that. We're to a point now where I don't want that job. I don't want to work for somebody else. I want to work for real people that have real companies. And so I brought on that guy. So long story short, we want to go to 25,000 units.
Okay.
And 5 years,
yeah,
we'll probably get to like 8 or 10 in 5 years, and then be, doing bigger and better deals as we go from there.
Yeah, good stuff. And why 25,000 doors? Any reason specifically, or?
I was just having fun with some big numbers and easy math. And, I'm 33. My sister's my partner now. We brought Jen and I have been doing it together since like a year or so after our dad went blind. And so she came in and ran the office and management company and hiring, firing, all that stuff, while I've kind of run the acquisitions. So her and I are 50-50 partners. We're both in our 30s. We have young kids, but it's like we might as well set a big target and build a fun team and go for it, Yep.
I love it. I love it. Why not, right? You got time, you got energy, you got the asset class, you get the knowledge, you'll learn as you go. I love it. So, well, thanks for coming on. If there was any way that our listeners could get a hold of you, what's the best way for them to get a hold of you?
Comfortcapital.com actually is our interface with people that are interested in the investment side. Comfort Communities is our property management interface. So comfortcommunities.com it's all the like how they pay rent and they look for communities, or if you want to look at our portfolio, it's there. Comfortcapital.com, and they can inquire and I'll get the email.
Well, thanks, Blake, and thanks everybody for tuning into today's episode. If you're ready to take action and start building wealth through multifamily real estate, we encourage you to reach out to us. Click the link below right now to take action and start changing your financial future. We will see you next week. Thanks again, Blake.
Awesome. Thank you. Thank you, Dan. See ya.